The first thing I'm going to talk about is charitable remainder trust, and what those are, as Attorney Fleming had mentioned, was a way for you to give to a charity while still retaining some of that interest, and that's why we call that a split interest trust, because you can retain some of that interest. So what it allows you to do is, if you have some money that you don't necessarily that you want to draw from, but you don't necessarily think you'll need to tap into. What it does is it allows you to receive an annual stream of income for a term of years or for your life, and receive a present year tax deduction. We'll get into a little more detail of what that means. But essentially, what that means, or what that does, is there are some restrictions on it. So there is, it is a construct of statute, of the Internal Revenue Code. And so there are some restrictions on it. You must be alive at the time the property is transferred to trust. This is a lifetime gift that would have to be. This is not something like where you leave it in your will or anything like that. It's not created after death. The charity can be, and for the amount given to charity must be at least 10% of the fair market value of assets. So essentially, and there's a calculation there based on your life expectancy, if it's for life, or based on the amount, the term that it is for, so that you're able to give. So there are certain limits, and also gives you the flexibility to swap out charities during your lifetime. So if you give to a charity, or you name a charity in a trust, and eventually that charity dissolves, or something happens that you wish to change the charity or change the proportion, you can still do that during your life. And the advantage to this is it gives you a present year tax deduction in the year you contribute to the trust. So if you're still working, if you're still earning income, and you want to set aside money in a charitable remainder trust for the Park District Foundation or any other charity, you get a present year tax deduction equal to the actuarial value of the remainder interest that will pass to the charity, essentially based on the age of the beneficiary, the amount, and the amount withdrawn over the lifetime. There's a calculation, and that gives you a specific amount that you are able to deduct in the year of the gift. So like Attorney Fleming had said, there are essentially two different types. There's actually a charitable lead trust, as he said, too, but we're going to focus on the charitable remainder trust, because those are the ones I think we see most often. That's what I saw in practice, and that's what we see here at Midland in the trust department. But essentially, the difference between the two is, for a charitable remainder annuity trust, what we shorten to a CRAT, is you receive a fixed amount at least annually. So let's say you have a large sum of money, or any sum of money, and that you can live off of $5,000, $10,000, $20,000 a year, whatever that number is. And again, it's got to be within those limits. So there are limits to it, so it has to fit into that formula. But you can set it up so that you receive that fixed dollar amount, and on an annual basis, distributed quarterly or monthly or however, but it would be calculated annually, and it'd be a fixed dollar amount. So what this does is allows you to set that money aside for charity, but still retain some interest, still get some benefit from that. A charitable remainder unit trust, or CRUT, is designed to pay a fixed percentage of the fair market value of the trust assets valued annually of the non-charitable beneficiary. So what that does is that allows you, to take 3% of the value of the asset as of December 31st, or whatever date, and then so that amount may go up, it may go down. This allows, based on the percentage, for the possibility to grow, and allow for your income stream to potentially grow as it grows. One of the advantages of a CRUT versus a CRAT is with a CRUT, you can make additional contributions. With a CRAT, it's fixed. Once you set that money aside, it's done because that money is fixed. That dollar amount you're pulling out is fixed. With a CRUT, in your lifetime, after you set it up, you can actually add more money to it. You can contribute more money to that CRUT, and then obviously the percentage grows. But that gives you a little bit more flexibility with a CRUT as opposed to a CRAT. And again, for the tax treatment, it's exempt from federal income tax under Section 664, and they do not file a 1041, but it does file a form 5227. So you'd probably need an accountant to help you fill out this form, and does issue K1s to the beneficiaries so the amount you pull out, either the CRUT or the CRAT amount, would be taxed to the extent of any gains or income that's in there. We'll talk about that in a minute. But and so they reflect earned income that's accumulated from the years and prior years, and they maintain the characterization when it is generated. So in other words, if you contribute to a charitable remainder trust, appreciated stock that you haven't, that you purchased years ago and that is appreciated in value. And if you put that in, you do not pay any capital gains tax when you put those in. But as you pull that out, there are what I like to call just stored capital gains in there. So as you pull that out, you will have on your K1 capital gains amounts, as well as the income that's been earned over the course of the year. So there is some tax consequences as you draw that out, but it just depends on how much stored gains there are on the assets you put in there, as well as how much income is earned on the assets that are in there to grow. If you did not put appreciated assets, if you just put cash in there, then most of what you pull out will be tax-free because it's already been there's no stored up gains. One of the things that people need to understand with charitable remainder trust is it is a completed gift. So there is, to some extent, you're actually giving it away, and that's one of the reasons why the IRS gives you a present day tax deduction, is because you're giving it away. And because it's a completed gift, there's no step up in basis, which means that stock you purchased for that you have appreciated gain in, when you contribute that to charitable remainder trust, it's still the same basis of what you did, and that's where the stored capital gains comes from. So there's no step up in basis. And also, one thing to consider too is when you die, there is also no step up in basis, as you would if those assets were sitting in your own personal trust, you would have a step up in basis. But because it's a completed gift, because it's been moved into a charitable remainder trust, there is no step up in basis. But in that sense, it's still going to charity, so there would be no tax consequences at that point, anyways. So, and also because it's a completed gift, you can't tap it. You can't get it back. So if you think you'll need this to purchase, to downsize the house or purchase something, you can't. It's not going to be available. One thing also to look at too is the fact that it's be subject to the 60-day look back for Medicaid planning. So again, this should be done with that in mind, if that's something that you're looking into. So because it's a completed gift, it does do the 60-day look back. But one thing to think about sort of too are some of the tax planning strategies. If you plan to give money to a charity at the time of death, a charitable remainder trust can be used for a current year income tax deduction. So although Most people, because of the limits are 11 million, the estate tax limits are about $11 million, and even if there's a change in Washington, those limits are probably still going to remain quite high. And so, giving to charity does not necessarily save you anything from an estate tax standpoint if you don't meet those limits anyways. But what a charitable remainder trust does is allow you to actually take advantage of some taxes while you're still living. And depending on the amount of tax savings that you generate as a result of your gift, you can sometimes use that tax savings to turn around and buy life insurance policy or some other financial vehicle, which would then replace the amount of money that goes into the charity. So in other words, if you have a $500,000, if you set up a charitable remainder trust with $500,000 and you get a tax savings, then a current year tax savings, and perhaps you can use some of that tax savings to purchase a $500,000 life insurance policy, which basically essentially allows you to give to the charity and to your family for the same amount. So there are some planning strategies that you can use with charitable remainder trusts. And some of the things that we see, I mean, we handle them, Midland States Bank. I had one just last year, which ended up going to the Park District as well. So this is something that people do, and it is something that you should talk to your advisors and planners about. So.